This is Ralph Sass, and this is the lecture for Accounting 211, Chapter 11, and this is part 2 of the lecture. And I'm going to pick it up here where we've left off with the stockholders' equity section of par value. You can also have preferred stock, and notice this: if we had preferred stock, its owner's equity section of the balance sheet is going to look very similar to the other one, only it's going to have a couple of extra lines. Notice the very first line. In this case, we have preferred stock. It's 9% cumulative. We'll talk about what that means here in a minute. It's got a $100 par. Preferred stock is usually sold at its par value, okay? Authorized shares 100,000, issued and outstanding 50,000. So they took the 50,000 times the $100 par to come up with that 5 million. Common stock, they took the $5 par times the 2 million shares outstanding, just like we saw on the last slide, to come up with the 10 million. Then they had additional paid in capital. That was additional amount that they paid when they went and bought those. The preferred stock there, usually that's a zero, or there's even nothing there. In this particular case, they paid more than a $100 par, but that's unusual. And so then they had total paid in capital of 35,500,000, retained earnings, and a total stockholders' equity section of 53 million. Bottom line, very similar to handling preferred as you do common as far as the journal entries go. The only difference is usually there is no additional paid in capital account. Couple of features of preferred stock. It is a separate stock. It usually has priority in some way, okay? It doesn't have to be dividend distribution, but that is usually the way it is preferred. The rate is almost always stated, so it's like a 5%. It's like a 5% rate, or a 10% rate, or a 3% rate. So preferred stock almost always has some sort of distribution rates. Okay. Some other features that can be included but don't have to be. One is cumulative dividend rights, which means if we don't pay you your dividend this year, next year, before any common dividends can be paid, and I've got a slide to show you this in a minute, you've got to pay me my dividends for this year at 5% or 10%, whatever that rate was, plus next year's before the common shareholders get any of their dividends. Preferred stock is many times callable, not always, but a lot of times it is callable by the company, which means that the company can say, hey, I want that stock back, and they'll buy it back. Usually they have to pay, there is some set amount that they'll have to pay you above the par value for it. Usually it's like 102% of par or something like that, some nominal amount, very similar to bonds, if you'll recall. And normally it has no voting rights. Sometimes there have been some preferred stocks that have extraordinary voting rights. Perhaps if the family wants to maintain control, they will give the preferred stock, and its preference will be that they get 10 times the each share gets 10 votes rather than one share, one vote. So usually that's unheard, that's not common, but it does occur, especially where a family started a company and then is issuing stock. It's their way to maintain control, even though they're selling stock to the public. Cumulative preferred, most stock is cumulative preferred, which means dividends in arrears, i.e. dividends that haven't been paid, have to be paid before dividends can be paid on the common stock. Okay. And non-cumulative is where if you miss a dividend payment this year, kind of so sad, too bad, you're out of luck. Those are more rare. Most preferred stock is what we call cumulative. So notice the way this works. We've got this company, they have 10,000 shares of $8 preferred and 50,000 shares of common stock. Okay. In the event it's non-cumulative, which is my example at the top there. Okay. Notice it doesn't say that the dividends. Notice in 2013, okay, there were no dividends. Okay, there were no dividends in arrears. So in 2014, when they paid the 20,000 in dividends, okay, they just paid the 20,000 in dividends because the dividend is what they call non-cumulative. Okay, that's the first example. But notice what happens in the bottom example. If the preferred stock is cumulative, they didn't pay me that in 2013, they paid me no dividends. Okay, in 2014, they paid me 20,000 in dividends, which means they're missing out, okay, on, whoops, sorry about that. Meaning they missed out on 60,000 in dividends. So that 60,000 is what we call in arrears. So in 2015, okay, the amount they're in arrears is 140 grand. How did they get that 140 grand? The 80 grand from the prior year, plus the 60 grand from 2013, plus the 60 grand from 2014. Okay, means that they have 140,000 in arrears, meaning they have to pay 140,000 to the preferred shareholders before any of the common shareholders will be paid any dividends. Sometimes preferred stock is what we call convertible, and it is typically convertible into common stock. And the reason why they do this is because usually preferred stock pays pretty high dividend rates, 6, 7, 8%. And what they want to do is to see that stock price go up. And then when that stock price goes up, what they want you to do is take that preferred stock and turn it into common stock. And if the price of the stock goes up, that's exactly what you'll do. Usually it'll tell you in the agreement when you buy the preferred stock, if it is convertible into common shares, what the ratio is. Usually it might be 10 shares to 1. In this example here, it was exactly 10 to 1 because they just converted 100 shares of preferred stock into 1,000 shares of common stock. Okay, and in this case, they ended up with a higher dividend yield. Usually you'd end up with less of a dividend yield, but it would be worth far more than you paid for it. As far as corporations classified by source, we've already saw this in the example. There was preferred stock, and then there's par and additional paid in capital, common stock, par and additional paid in capital, and then retained earnings, which is the accumulated earnings over the years. One quick note about preferred stock: a lot of companies have 2, 3, 4, 5, 10 different types of preferred stocks. It would not be unheard of for there to be a preferred Class A, a preferred Class B, a preferred Class C. So it's not unusual for there to be a number of different preferred stocks, all with different par values, perhaps, all with different dividend rates, likely. Just depending upon the company, what have you. A lot of banks have a lot of preferred stocks that are variable as far as their par value in addition and their dividends. The book value for common shares, okay, is we take the total stockholders' equity and then we subtract the preferred stock and preferred dividends and arrears are deducted, okay. So we only have the common stockholders' equity divided by the number of common shares outstanding, and that'll tell us what our book value is. And the way to interpret that is it's what it's on our books for. Okay, it will almost never equal market value. In fact, the market value will almost always be higher than the book value. But that's how you figure out the book value. Okay, so notice how we have the total stockholders' equity in this case is 2,380,000. The par value of the common stock is $1 million. Dividends and arrears in this case are 80 grand. So we have to subtract the 1,080,000. So the equity of the common shareholders is 1,003,000. In this case, there were 50,000 shares outstanding. So we take the 1,300,000 divided by 50,000, and we come up with $26 per share as the book value of the common shareholders. Notice what happens here. The issuer of stock, General Motors, Ford, Bank of America, what have you, the common stock is always carried at the original issue price. So the fact that the stock price went up today or down today, what have you, does not matter to the company. They never make a journal entry to record that. The only spot where the market value matters is to you and I as the investors. Okay, when you and I are investors, we're going to worry about that stock market going up or down because that's going to be carried on our balance sheet at their market value. But the issuer of the stock does not change their records based upon what happened or what happens in the stock market. Some things that affect preferred stock, and I talk about this more in a finance class. Um, the market of a preferred stock is determined based upon its dividend rate, its risk, and the level of interest rates. You all have heard me say before, when interest rates go up, the value of bonds go down. Much the same happens with preferred stocks. When interest rates go up, the value of preferred stocks tend to go down, unless they're convertible into common stock, what have you. And when interest rates go down, preferred stocks tend to go up, because they are very closely, they trade very similarly to bonds. And the reason why they do that is because the dividend is fixed. The return based upon the market value is called the dividend yield. If we take the dividend and divide it by the price of the particular stock, that will give us the dividend yield. Prices of common stocks change daily. And notice the investor expectations of future profitability is probably the biggest factor in the value of a common stock. When you see a stock that's gone up $10 or $20 in a day or down $10 or $20 in a day, the reason why that has occurred is most often that your expectation of the future profitability has changed. Maybe they've just reported earnings. Maybe they just lost a big customer. Maybe they just gained a big customer. Maybe you've got a new president who says that tax rates are going to fall, but there's been some changes in expectations of the future, and because of that, that changes the value of the stock. That's probably the most common reason. You'll often hear of stock splits. They were a lot more common in the past. They're not used as frequently today. Okay, but from an accounting perspective, we've got a little change to make from an accounting perspective, but it really is minute. Notice, in a stock split, outstanding shares increase, but par value is decreased proportionately. So let's see how this works with the numbers. Before the split, we had 1 million shares, and they were $10 par for a total par value of 10 million. In this particular case, they did a 2-for-1 stock split. Quick note about why we would do a 2-for-1 stock split. In this case, the market price of the stock was $90. Okay, what that means is and I mentioned this earlier, a round lot is 100 shares. You have to buy basically $9,000 worth of stock, and all you're going to get is 100 shares of this particular company, Felix Company. That's a lot of money. And it's especially a lot of money when you consider that in order to build a diversified portfolio, you need to buy about 20 stocks. The statistics and the finance tell us that you have to buy about 20 stocks to build a diversified portfolio. If each one is $90, I've got to invest 180 grand, which is more money than most of us have. So what they'll do is they will do a stock split, in this case 2-for-1. Now the price on the stock exchange is $45. Now to buy a round lot, it's only $4,500. Now it no longer takes 180 grand to build that diversified portfolio, but theoretically at least only 90 grand if everybody did it, if all the stocks did it. So that's the reason why companies do it. Notice what happens after the split. The number of common shares go from 1 million to 2 million. The par value of each gets cut in half, so it goes from $10 to $5, but there's no change in the total par value. So what shows up on the balance sheet as total par value doesn't change. All that changes is the number of shares that are outstanding, as well as the par value is going to decrease from $10 to $5. As I mentioned earlier, some companies buy back their stock. When they buy back their stock, it's called treasury stock. You cannot vote for it. You cannot vote it, and you do not get dividends. So when a company buys back their stock, they can't vote that stock or get dividends on that stock. It is a contra equity account, which means it's an equity account with that funny balance. Okay, so we expect equity accounts to have credit balances, so it's going to be an equity account with a debit balance. And I already talked that there were issued shares that have been reacquired. So let's look at what happens here. In this particular case, we reacquired 1,600 shares of its $5 common par on the market at 90 grand. Prepare the journal entry. Notice what happens. cash goes down by 144 grand, treasury stock goes up by 144 grand. Keep in mind it's an equity account with a funny balance, a debit balance. And the way we got that is just took the 1,600 shares times 90 bucks. Notice we do not change the paid in capital, and we do not change the capital account. Now, if they sold the shares, they sold the shares for $115 per share. They sold 1,000 at $115 per share. Notice what my journal entry looks like for this. I have to put the cash in my account for 115 grand, 1,000 shares at 115. I've got to get it out of my treasury stock at what I put it in there for. So that's going to be at the $90 cost. And the profit, okay, in this case 25 grand, is going to go into additional paid in capital treasury stock. And I will probably have to report that and pay taxes on that. And notice what will happen if we take a look at the stockholders' equity, what's going on in the stockholders' equity account. At the very bottom, it's got less treasury stock, 690 bucks a share. Usually, I've seen this further up on that stockholders' equity section of the balance sheet. In fact, it's usually right in this case under common stock, but someplace in there they'll tell you how many treasury shares they own. Some companies do buyback programs where they buy back stock, and the purpose of buying back stock is twofold. One is by buying back stock, they're increasing the demand for that stock and pushing up the price, which current shareholders will like and appreciate. And then the other reason is it's part of an employee compensation plan where they're going to distribute those shares to their employees for doing a good job. And I already talked about that. There are two ratios we need to be aware of. One is return on total assets, which is net income divided by average total assets. Average total assets are beginning assets plus ending assets divided by 2. And that number, return on assets, is probably going to be a number, hopefully 8, 9, 10%. And then finally, we'll have return on common equity, which is also net income divided by average common shareholders' equity. Once again, beginning common shareholders' equity plus ending of the year, what have you, ending common shareholders' equity, and once again divided by 2. And hopefully that's going to be in the teens as far as a percentage goes. So those are two of the ratios that are appropriate for this chapter. That concludes chapter 11. As always, if you have any questions, please feel free to let me know. Thank you.